Welcome back. You have now registered your business, obtained the necessary licenses, and finally open a bank account for your business. Now what's next? Business is booming and you need capital to finance your growth. Getting a bank loan can be tough, especially if you're running a small business. But what if I told you that banks use a clear and structured way to decide whether to say yes or no? In this module, we'll demystify what banks look for when reviewing your loan application. Learning outcome. By the end of this session, you'll understand the 5 C's of credit, which banks use to assess the borrower, the importance of cash flow and repayment ability, and what makes your business more attractive to banks. Part 1. The 5 C's of credit. Banks don't just look at your sales or your business name. They evaluate your business using 5 major criteria, known as the 5 C's. Character. This refers to your credit history. Have you paid your previous loans or suppliers on time? Banks look at CRIS and CTOS reports to judge whether you're trustworthy. Capacity. This is about your ability to pay the loan. Banks assess your revenue, cash flow, and expenses to calculate whether you can afford the repayments. Capital. How much of your own money have you put into your business? If you're not willing to invest in yourself, why should the bank? Collateral. This refers to any asset that can be used as security, property, machinery, or fixed deposits, and not forgetting CGC guarantee. Conditions. What's happening in your industry and the economy? Even if your business is strong, external risks can affect the bank's decision. These 5 C's help banks reduce their risk, and if you understand them, you'll know how to prepare better. Part 2. In the 5 C's of credit, we spoke about capacity. The banks use a certain financial term to determine the borrower's repayment capacity. The debt service coverage ratio, DSCR. One major number banks look at is your debt service coverage ratio, or DSCR. This is a simple formula. DSCR equals net operating income, excluding non-cash expenses, divided by total debt payments. A DSCR of 1 means you are able to repay your loan payments. Anything below 1 means you're not making enough to cover your loan payments, and that's a red flag. Ideally, you would want your DSCR to be above 1, which signifies your business ability to repay debt commitments with comfort and buffer. Note: if you are unsure how to calculate your net income, excluding non-cash expenses, and total debt payments, don't worry, we have a module on this shortly. Part 3. Why cash flow matters more than profit. Many SME owners believe that if they're profitable, they can get a loan. That's not always true. Imagine you made $100,000 in profit, but most of that is stuck in unpaid invoices. You can't pay your supplier with invoices. That's why cash flow, the actual money going in and out of your bank account, is more important to lenders than just profit. Clipboard. Part 4. Business purpose and sustainability. The bank also wants to know, why do you want the loan? Are you expanding operations, buying equipment, hiring staff? A well-defined business purpose makes your application more credible. And more recently, banks are looking into the sustainability of your business. Does it follow basic ESG, environmental, social, governance practices? Even simple things like fair employment or waste management can show that your business is future-ready. Real-life example. Let's take Kedai Kopi Minor, a small coffee shop. Minor has been running it for 3 years and wants to apply for $100,000 loan to renovate and expand her kitchen. She prepares 3 years of financials, shows that he has a positive cash flow, and sufficient to repay the loan repayment with DSCR of 1.25. She also explains that the renovation will let her serve more customers and increase revenue. She even offers his kitchen equipment as partial collateral and is agreeable for CGC to step to guarantee 50% of the loan. Lastly, she has kept a good repayment record, see Chris, for her personal borrowings such as her credit card, car hire purchase and home mortgage. The bank sees that Mina has strong character, capacity, capital, and a clear condition for growth. This is what a complete application looks like, and it gets approved. Closing summary. Bank financing is possible when you speak the bank's language. The 5 C's, DSCR, positive cash flow, and a clear business purpose form the backbone of any successful application. In the next module, we'll explore how to calculate your repayment capacity or debt service cover ratio.